Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Good morning and a very happy Sunday to everybody. I appreciate you joining us. This is a radio about giving you sincere and actionable ideas so you too can improve the outcome of yourself and your loved ones financially. And I got news, whether it's the high price of gas, whether it's healthcare, whether it's this, whether it's that, Americans are worried because the pace of news, the pace of information, the cost of life continuously gets more expensive. I endeavor, along with my co-host David, whether it's areas of investing, fast markets, whether it's taxation, whether it's estate, retiree healthcare, long-term care, whatever's in the news, we bring it to you because we want you to make sure you're thriving throughout your retirement years. So connect with us today, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. David, leading into this opening segment on a Sunday, you had brought in an article. Break this thing down. Let's get into the weeds.
Yeah, so the title of the article is Risk, Not Volatility, is the Real Enemy for Investors. And I thought that was an intriguing article, so spent the time to read it before the show. And the point the author was making was volatility is the toll we pay when we invest. Stock prices go up and down. We know together stock prices generally move higher over time. But we have months like March where we have a peak to trough decline of 9%. Is that volatility or is it a risk? We would argue that's volatility. I thought maybe what we could do today is actually break down retirement risks that people don't always think about. And I was having a conversation with someone the other day about how much cash they have going into retirement. And I think they were surprised that I had suggested that they build their reserves in the bank before they retire, meaning I think they thought I was going to say, because I'm in the investment world, hey, look, we need more money to invest. But really what I was encouraging them to do was lock up some capital in something that was FDIC insured just in case. I don't know about you, Craig, but I really do believe that cash is an asset class. And everybody who's going into retirement should consider how much they have, because it's not easy to get that cash once you're no longer getting that paycheck.
No, David, you're absolutely correct. So listen, guys, volatility is uncomfortable, but volatility is only that. It's being uncomfortable. You want to know what risk is? Risk is permanent damage to your capital base, okay? Don't let risk happen to you. Now, one of the ways to measure through this, the psychological effects, but it's also common sense, is to do what David said, to make sure we have ample amounts of free cash flow and ample amounts of cash reserves. And the amount of cash reserves that you should have on hand is going to depend on your unique situation. It's also going to depend on the economic backdrop that we find ourselves into. Because when everything is going great, the economy is not too hot, the economy's not too cold, it's just about right, I don't think it's as important to have those excess cash balances. But when the uncertainty starts to reign its ugly head, when the volatility gets a little bit more difficult, when you recognize that the jobs market says fragile or fragile, I'm not sure how it's supposed to be pronounced, that's when you want to make sure you build up those cash reserves. And cash reserves can come in different forms. There always needs to be enough physical cash, I think, at some form of a brick and mortar bank that you can just drive to go ahead and have them fill up a suitcase full of money. Why would you ever need a suitcase full of money? Probably don't. It just feels good to be able to say you could do that in single dollar bills, probably. But the other portions of that cash, that's why treasury bills and treasury bonds exist. Ask yourself for a minute, have you or your advisor ever booked individual treasuries into your account? If not, why not? You should deserve to know. Probably because those advisors don't have a strong enough fixed income desk with dedicated traders. Part number two, are your advisors consistently watching to generate real returns? Because everything you touch, guys, needs to have a real return. And that means your high yield money markets, your treasuries, your short-term agency, your short-term asset-backed, your multi-asset class, multi-sector, short-duration fixed income portfolio, which is the next place you start to build. You need to make sure you don't have nominal yields. You need to make sure that you have real yields above the inflation rate. And those are all things that we stand to deliver and we're good at VestGen Wealth Partners. So if I frame this back up and we bring it back to David, the framing today is there's a distinction between volatility, which is uncomfortable, and risk that creates permanent damage. And I think too many people are oftentimes confusing market movement with actual financial danger. But if you too want to have a sleep at night portfolio, you got to build from the foundation up, because a strong foundation is the cornerstone to everything that occurs. And that means having successful strategies for the equivalency of what we deem our cash flow reserve accounts. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com.
So risk number two, I just jotted this down, is healthcare. Now, sounds like maybe it's not a big deal, but I think part of our job at VestGen is to create transparency for folks. What does it look like when we transition into retiree healthcare? And that comes in two parts. If we're retiring before Medicare eligibility, well, then we have to go find that healthcare. What is the real cost to get that healthcare off the exchange? And then what's the cost when we hit 65 and we hop onto Medicare? We get Part A, which is free. We get Part B, which has a premium. And then we have to get our Medigap, our supplements, or our Advantage plans. If we're not properly budgeting for that healthcare, we might be undersaved $10,000, $20,000 a year. And what account are we going to source that capital from? Do we know exactly where the first couple years of healthcare premiums are going to come from? I think that's a huge deal, Craig, especially as some of the rules have changed with subsidies. A lot of folks aspire to get out at 62, at 63, but we need to have clarity as to, well, where's that insurance going to come from? And God forbid we have people that are different ages. It might not be a 2-year gap. It could be a 4 or 5 year gap for a couple if we're not the same age.
And it starts with the model. There are far too many online calculators and far too many practitioners that do not have an appreciation for the full effects and cost drag of retiree healthcare premiums. As David said, you kind of break that into two different times during your life: retiring pre-Medicare, meaning pre-65, and retiring after Medicare, after 65. And let's be clear, guys, if you have traditional, large, credible group healthcare coverage and you're retiring pre-Medicare, there's a great chance that you might want to go ahead and ride Cobra for the first 18 months. But have you checked out how big your Cobra rates are going to be? They're going to be ginormous, because those Cobra rates means you're paying the unsubsidized portion. You're paying the full freight, employee plus what used to be employer coverage. Get ready for sticker shock. But David, it provides an easy 18-month runway. Then once you're off of that, if you're still not bridging into Medicare at the age of 65, then it's likely that you're going to go into an ACA compliant plan or something called a self-insured community-based risk pool. And you are going to have to make sure that you work with competent professionals that can help guide you through the process. And the process is not just selecting your gold, silver, or bronze plan on the exchange. The process is what David alluded to, which is where's the money going to come from for those premiums and why. And that's why I encourage everybody, if you're a low consumer of healthcare and you listen to this program with great frequency, then I want, whether it's you or whether it's a younger family member, I want you to pull out your Swiss Army knife right now today, because the Swiss Army knife is your HSA. Because if we can get you to start funding pre-tax dollars, tax-deductible dollars into a health savings account today, we can get you in a position to invest that HSA in great companies of America, so you don't just earn interest, but you compound your money. And now, after a series of years or possibly decades, we've created a preordained destination that is triple tax preference. That's right. Tax deductible dollars, tax deferred growth with tax-free distributions. So you too can start bridging the gap on your retiree healthcare premiums with a preordained bucket of money. Gosh, it's glorious. If you want to learn more, I think you can. And here's how you're going to do it. Call us today, 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. That's getretiredstayretired.com. Connect with us for a free complimentary consultation. Meet with David and myself, and let's talk about what it's going to take to help you not just get retired, but stay retired. All right, more hard-hitting, actionable ideas that you need to make sure that you're living your best life. That's what this show is all about. We're going to pay some bills. That's a commercial break, and we're going to come right back. You're listening to Craig and David Bolanos in the Know Radio with your favorite team, VestGen Wealth Partners on AM 560, The Answer.
You want more in the Know Radio? You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
Hey, if you missed what we were talking about in the A block, it's a combination of effectively managing and paying for your retiree healthcare costs and making sure you too are getting the psychological edge by appropriately building out your storages of value that begin with a strong foundation in any financial plan, which is cash and cash equivalency using individual bonds, asset-backed paper, agency debt, all to guarantee or generate what we call real returns. Those are returns to ensure that you're outpacing inflation. David, all of this stemmed from an article that you were reading, and bring us back into this conversation about what it takes to get retired and stay retired.
Yeah, so the concept was, are we more concerned about volatility, or should we really be focused on retirement risks? Volatility is asset prices going up and down, but there are real risks that need to be addressed. And the only way to address those risks is to build out a comprehensive retirement plan. So risk number one that we had was not having enough cash going into retirement. Risk number two is not properly figuring out how much your healthcare is going to cost and where the money is going to come from. Number three is almost on the opposite end of the spectrum, Craig. So a lot of times we talk about barbelling investment strategies. We talked about having cash, the really safe side of the barbell. I'm going to go to the opposite side and say one of the biggest risks that I think people have is they're actually not invested enough in the markets, meaning they're so nervous about stock market volatility that they don't have an appropriate plan to grow their income over time. And when you see gas prices moving up as quickly and you see inflation all over the TV, I think this is actually the reminder that if people don't grow their assets, that they're eventually going to run into a cash flow problem, which is what we call the fallen angel investors, the folks that took the easy path early on, perhaps locked in some interest rates that were fixed. And while that makes them feel good, I get nervous that in their 70s, 80s, or maybe even their 90s, that their lifestyle is just going to be completely upended because they never grew their capital base.
No, David, that's so important to say because remember, guys, we talk about it time and time again. What David is saying is one of the biggest mistakes people make is investing for retirement, not investing through retirement. Guys, retirement isn't the finish line. It's just the start of a new journey. Retirement's about what do we want to be when we grow up. You got to continue investing while you're growing up still, because being too conservative is just as risky as being too aggressive, because again, inflation's the silent threat. We know how this goes. Cash and ultra conservative portfolios, boy, they feel good when nothing looks good on the news. They feel good when the media doesn't treat people fairly. But the reality is, you got to do everything you can to grow your capital base over time if you ever have a chance to grow your income over time. And that's why David's bringing up this subject right about now. The big secret, guys, I shouldn't give it away, but I want to, is there's a backdrop that's here. I know the dangers are real. You know the dangers are real. I understand the high tax of oil. I understand the risks of global conflicts. I understand a market trading at 22 times earnings. I get these bigger pops, and more importantly, we're worried about these larger drops. I get concentration risk in the S&P. But remember, you gotta find a way to grow your capital base consistently over time if you want to grow your income over time. And that's what you need. And that's why VestGen Wealth Partners is here. David, talk a little bit about how you do that and how you help clients relative to the financial planning process create that risk budget, which is very different than the risk tolerance. Talk about how that budget expands sometimes over time and what needs to be done.
Yeah, I mean, I think for me, I always try to explain it as what's the minimum rate of return we need to earn on a certain portion of the portfolio to get you retired and keep you retired. So what's our capital base look like? And what's the minimum going to be to get this done? Most of the families we work with, once we figure that out, we oftentimes find that we might have some excess capital out there. So some extra money we might not using. And that's awesome because that gives us flexibility. Some families might take a more conservative approach and put that in safe investments. I think most families understand there's probably a balancing act where they can allocate capital to some longer term investments to grow their portfolio and ultimately pass that on to the next generation. So that's where we're going to start. We're going to start with what do we need to earn to get you retired and keep you retired? Then what we're going to do is we're going to create some clarity around how cash flow is going to work. If I sit down with a family, it would be very common that they might have multiple IRAs from multiple former employers. And if we have a couple, maybe he has a Roth IRA and she has a Roth IRA. Well, our game plan is not going to be take a little bit of money out of all of those accounts every year. We're going to create a specific liquidation order for those accounts. This is what gets spent first, second, or third, so that we can properly fund these different baskets with the appropriate investments and the appropriate amounts of capital. That way, no matter what happens, there's clear line of sight for the retiree to see where their cash flow is coming. And they also know on the other side of that barbell that they're going to have something that's going to participate in this next major wave of the economy. And I mean, we talk about it every week, but like this AI thing is going to continue to go. And maybe next segment, we talk about revenge of the old economy because I got some talking points on that. But that's how we do it is we have to start with what your family's plan is, and then we will reverse engineer how the investments fall into place and what different account types fit best for these different investment strategies.
So if you're ready to start building, which means you got to start talking about it, a crystal clear, compelling vision of your future. And we have clients all across the country We know, generally speaking, what it takes, depending on certain lifestyle and certain pre-retirement income levels, to make this thing work. Let us do the hard work for you. And then, as David said, we can start going through the financial discovery process, leading us to a pathway to yes. And that's a pathway to yes, which is really a pathway to success, meaning designing a strategy your way. Because all of us have been shaped, but not by what we read in a book, not with what we see online. We've been shaped by our experiences. It's the experiences that dictate the way we think. And to the extent that you can communicate and share that with us, then we too can find a path forward. I mean, David, a client I just visited with the other day was really simple. They wanted to be worry-free, risk-free for the first 10 years in retirement. And we literally built out a sophisticated portfolio of individual bonds and individual credits, layered in some preferred perpetuals, institutional style par value. And we've literally solved for what was $10,000 a month of distribution, literally $10,000 a month of distribution each month for the first 10 years, with principal returning at maturity. And there you go. The rest of the capital then is designed for growth, because people know that the biggest danger isn't market volatility, it's insufficient growth. And David, you were a big part of those conversations as we worked with our institutional fixed income desk and our friends at Piper Sandler to go ahead and build out the credits.
Well, I mean, the retirement red zone, for lack of a better term, is that first 5 to 10 years of retirement. If you blow it early on and you're taking portfolio distributions, you're not going to be able to recover. So if we can do the forward planning and we can do that simple laddering strategy and build in those satellites to enhance income, I mean, who wouldn't want that? Right? I mean, it sounds so simple, but sometimes the most obvious clues are deceptive. Let's really start thinking about what we want your first several years of retirement to look like. Let's hunker down. Let's stay retired, because that also gives your family the opportunity to then grow all the rest of the money. And I think the best part of our job, Craig, is being able to see this money transition, not just one generation, but often 2 generations. And it makes us feel, I think, so fantastic that we're just a small part of building that legacy for folks. It really does work if you put the effort in up front.
Absolutely. 833-964-PLAN. That's 833-964-PLAN. Go out to that website, getretiredstayretired.com. When you're on the website, download from getretiredstayretired.com any of our custom free publications. Download for free our most recent quarterly conference call so you too can get insight as to what it is that we're doing to navigate these markets. And most importantly, use that to connect with us so we can start helping your family utilize strategies that are TNT, tested in the trenches, because you too deserve to worry less to live a lot more. Well, I'm excited for this next segment because everyone loves a good revenge story. More to come. Craig and David Bolanos in the know.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
Revenge is a very popular subject. Revenge is something that's incredibly entertaining. So David mentioned revenge. Revenge of who? Revenge of what? And how do you turn revenge into an investable theme to make sure you drive your 401k into a 501k? David, bring us into your revenge discussion.
There's a simple framework for today's market. Can AI replicate what a business does or sells? Answer yes. That company is likely out of favor today. Answer no. It's probably doing just fine. And I think that dynamic has fueled a rotation into parts of what I would call the old economy. I mean, coming into this year, if you started to read all of the forecasts from the major investment banks, I don't think a lot of people were looking for energy, materials, and industrials to be 3 out of the 4 best performing sectors of the year. But with a little help from the political conflict that we've got going on in the Middle East and all of this CapEx for AI infrastructure, I mean, portfolios have changed a lot. And I think that's a good thing. I mean, to me, it's a good thing that you're starting to see other sectors take the lead. But this is crazy to see energy becoming a bigger part of portfolios and people looking at material companies today. That was the last thing people were looking at 12 months ago.
So let's say it. Guys, this isn't revenge of the nerds, although we're financial nerds. This is revenge of the old economy. So revenge of the old economy is the investment theme that describes periods when these traditional, asset-heavy, often overlooked industries outperform high growth or disruptive sectors, especially after the years of dominance. David said it right. Energy enthusiasm, industrials, manufacturing, materials. Yes, I added one, David. Manufacturing. There just might be some brilliance in some of the things that are happening. I mean, even look at the most recent tax law, David. Tax deductibility of auto loans. Listen, the writers of that new tax law called the One Big Beautiful Bill Act, they didn't say tax deductibility for autos made in America. They recognize what America is about right now. It's tax deductibility of auto loan interest for vehicles assembled in America. So, David, how at VestGen Wealth Partners are we helping people do the asset rotation into these other sectors in order to have meaningful participation in the markets while keeping an eye on their risk budget, because you want to make sure you don't get overextended in any one area?
Owning businesses that AI can't replace, I think, is a basic diversification strategy for everybody's portfolio today. And the way I phrase it to clients all the time is like, does it consume the energy or does it produce it, right? Things are a little bit different right now. But this falls into the themes that we were talking about in the earlier segment, Craig, which is if we're going to retire, we're going to need some assets that still grow. And one of my favorite ways to grow capital for retirement is to own companies that generate cash flow, aka dividends to me, the investor, but also have a really good history of increasing those dividends at a rate equal to, if not much higher than inflation. And with a little bit of due diligence, investors can build portfolios just like that. So if we're looking to broaden out our investment exposure to some of these other sectors that may have been shunned the last couple of years, the really interesting thing is a lot of those sectors pay nice dividends. Many of those individual investments grow their dividends. And if you want to stay in the stock market game, but you need to take the edge off, creating a portfolio of dividend growing stocks for a portion of your portfolio might be a way to kind of meet all of those objectives.
Yeah, I mean, listen, everybody knows the cloud still matters. But so does copper, pipelines, and power grids. They matter too. And when you're in an environment where we're at right here, when inflation returns, those older economy stocks often benefit. Why? Higher commodity prices, pricing power, aka real assets, and higher interest rates caused by oil shocks and inflation spikes. They tend to hurt growth stocks. It just is what it is. But meanwhile, those cash flow heavy traditional businesses become more attractive. So we've talked about industrial sectors. We've talked about infrastructure, because we need to power this world. That's not just a US story, that's an around the globe thing. But I'm happy that we're massive exporters of energy in the US. Powering the world, that's not just for the reindustrialization. That's not just for the defense replacement cycle. Powering the world is powering the data centers, which is where the artificial intelligence lives. And there's different ways to access not just publicly traded markets, but privately traded markets. And you deserve to work with a firm that can do both. David, why should people take a barbell approach when they're accessing infrastructure and other critical names by doing publicly traded securities and considering doing some work on the private side?
Valuations, right? Early in the year, we had talked about as the markets moved higher the last 3 years, stocks are getting a little bit frothy. We have higher valuations no matter what metric you're looking at. And with those higher valuations, perhaps the forward-looking returns look a little bit more muted. If you're looking to move capital, recalibrate portfolios to other things that might not be trading at such a premium, then I think the private markets are one area folks can look at. But again, this comes down to education, not education of, hey, I'm going to call my advisor and see if they know anything about that. If they haven't brought it up to you already, chances are they don't know anything about it and they don't know how to implement it in portfolios. This is something that people should be asking you about if you have interest in, because that means that they are doing it throughout their client base. They're well versed in the different opportunities. They understand the taxes, liquidity risk, and the upside that could potentially come in your portfolio.
And David, I think a big part of the reason that advisors don't talk about the private markets, not just the public, is they don't have the access. And because they don't have the access, they don't have the education. And when you don't have the access and you don't have the education, it means you're going to come up short because you can't deliver the expertise. So what is it that makes VestGen Wealth Partners special when it comes to the curation of both public and, in this case, private investment offerings?
If you're not getting that proactive advice, it could mean that the client base for the existing broker advisor is not homogenous. I think one of the things that makes our business very unique at VestGen is we have a homogenous client group in the sense that everybody we work with is on that sprint towards retirement or recently retired. They're all dealing with the same issues, albeit they might be handling those issues in different ways because everybody's in a different tax return. But I think what people take solace in knowing is whether or not we act as your CPA, whether or not we act as your estate planning attorney, we know our way in and out of a 1040. We know how these estate plans get put together because we sit in on all the estate planning meetings with the attorneys. And if you're out there thinking, hey, I have stuff, I have wills and trusts, or I have talked about doing Roth conversions, but it's just at a very cursory level, we're here to tell you there's a different way to do it. And those get down to just having deeper conversations and learning about all of the strategies that are available to you. Because I think what investors might not recognize is once you get to a certain level, there is a whole nother world out there. You just got to find the best pathway to access it. And VestGen offers that pathway through our process.
Absolutely. And that process is called the VestGen Vision Planning Process. It's aligning your resources with what matters most in life. It's giving you a systematic, tested in the trenches, repeatable process that is going to get you to a preordained destination of success when you integrate all of these different financial aspects. I invite you to go through that VestGen vision planning process with us. Call us today, 833-964-PLAN. Go up to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
You've been listening to a whole bunch of information that you can harness to improve the life of yourself and your loved ones financially. I mean, we talked about the revenge of the old economy. I love that idea. It's a thematic implementation as this market goes through a bona fide asset rotation. In the same way we've talked about weeks past about the rotation from a geographical standpoint, there's a rotation amongst sectors inside this North American, this U.S. market. David, what is compelling that you think investors, listeners, and retirees want to know about how to be successful and how to start living their best life in retirement?
I think a lot of people are just in search of confidence, right? Folks want to have a partner, someone to advocate for them. So as they're planning this stuff out and trying to align their portfolios and their strategy with their value system, that they have a partner that's actually done this before. I mean, let's just take markets, for example. We spent last Friday on a conference call with all of our clients talking about this disconnect where some folks in the media now believe that the stock market has completely disconnected from reality. Our job at VestGen is to kind of get through that clutter and get through some of that talk and actually break it down and talk about the real data. And to us, I think, for the most part, I actually think that the stock market is well tied to the macro data. We've seen improving leading economic indicators as opposed to like where we were in September of 2025. Earnings season's been pretty good. Most companies have beat profit expectations. That's why the market's going up. So part of our job is to instill confidence, but part of our job is also to plan for some of this volatility and make sure that as practitioners that we're also not getting complacent. And so the way that we do that in portfolios specifically is when we are trading at all-time highs, our team behind the scenes that's not on the show is going through and making sure that we are trimming, we are taking some profits to build up those cash reserves for a rainy day. That's how we handle it on the investment side. For the tax side, I think it's about not having conversations in April and having conversations January through December, because that's when the strategy is happening. Most tax strategy for us happens June through December. It does not happen after the return comes because it's too late by then. And that happens in strategy sessions throughout the year. And that's usually the first place I start with all of our strategy sessions, Craig. I'm sure you're talking about the same thing with families that you're working with today.
Well, David, I am. We're spending a lot of time talking again about real return investing, which is ultimately about protecting lifestyle, not just nominal account balances. I mean, there are far too many diversified portfolios today that I don't think account for the inflation regimen that we're currently in. And if you didn't know we're in one, guys, we've been in one ever since there was too much money printed. We're in a whole different higher for longer inflation regimen, and people got to be doing things about that if they want to have defined and improved outcomes. I mean, listen, guys, it's real. I mean, what's real? All the central bank policy issues you hear about that are nuanced, they're real. The excessive debt, they're real. The currency debasement threats, they're real. The financial system stress, it's real. Now, that doesn't mean you have to be in gloom and doomer, but you better start taking an ounce of prevention, which can oftentimes be a pound of cure. And whether that leads you into some of the nuance about the revenge of the old economy, because commodities and hard assets and the halo effect can and do matter. Precious metals do have their place in people's portfolios. I get that they don't generate earnings or cash flow. I get that the prices could be volatile, but you know what? You don't build a portfolio just around stocks and bonds. You build a portfolio around a multi-asset class selection process that is in fact globally diversified, because you got to diversify the currency risk. Listen, if central banks are diversifying their currency, why shouldn't you as a human do it? And that's a lot of the things, David, that I'm having conversations with about in the conference room with clients who want to make sure they're long-term sustainable, and it's our job to deliver.
The way I think about that is portfolio defense during inflationary growth, right? Like things are growing, but now inflation's back. And in that environment, when you're thinking about playing defense, it's not as simple as just selling stocks and sitting in cash, or it's not as simple as selling stocks and buying a bond mutual fund. Let's go back to 2022 where we started to have issues with inflation, the Fed's raising rates rapidly to fight that inflation. Fixed income didn't work the way people expected it to. You had to modify your portfolio for that inflation. So if you're in a target date retirement fund and that target date retirement fund says we have half our money in stocks to grow and half of our money in bonds to provide protection, the question you have to ask yourself is, if we have rising inflation, I mean, what is the enemy of the bond market? The enemy of the bond market is interest rate risk, aka inflation risk. Are you appropriately positioned today for this environment? This is an environment that anybody wants to be in, but it's the reality of where we sit. And I'm okay that we're growing. I just understand that the backdrop is a little bit different. And that's why I think you're saying, Craig, that investors need to look at some of these other asset classes. They might be non-traditional to some, but they've proven to work in this type of environment.
Yeah, there's a new environment. There's a new sheriff in town. There's nothing wrong with the 60-40 guys, but start spending a hell of a lot more time. Yeah, I'm going to say that. Start spending a hell of a lot more time looking at that 40% that's in your portfolio. Because if you don't know it, listen, the bond market is oftentimes the smart money. I'm happy the stock market's at all-time highs, but David, how do you explain the fact that prior to the war in Iran, the 10-year Treasury was at 396? Now we're trading plus or minus 4.4. That's a 40 to 50 basis point swing. That's telling people something about this underlying inflation story. And that is why VestGen Wealth Partners has created its real return portfolios. The real return portfolios are not just focused on nominal returns. They're focused on real returns because we recognize the risk that comes from currency risk, that's de-dollarization, the risk that comes from normal inflationary pressures. And we want people to start thinking outside of the box, not because stocks and bonds aren't good enough, but stocks and bonds alone are likely not optimal when you're living in a new inflation regimen, which is where we have long found ourselves ever since we overstimulated the economy, which overstimulated asset prices, which has caused a permanent level of reinflationary pressures that is also now supported by an exacerbation of emerging market countries and others who no longer want to be as dollar denominated as they once were. If you want to learn about real return investing and connect with VestGen's real return portfolios, I want you to give us a call today. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, because real return investing is about protecting what matters most, your lifestyle, not just account balances. And that's why far too many diversified portfolios aren't including the right mix of assets in order to get you over to the goal line. You deserve, again, to thrive, not survive in retirement. And that's what your friends at VestGen Wealth Partners are here to do. So connect with myself, connect with David, and let's get this done. GetRetiredStayRetired.com. You're listening to In the Know with VestGen Wealth Partners, Craig and David Bolanos on AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560, The Answer.
So we covered so much ground today, but I got to make sure we recognize something else. That long-term care, financial planning in the shadows of dementia, I think remains one of the avalanche issues in American financial planning that people aren't properly addressing. And there is a real reason, and there is a definitive ability for the right families with the right strategies to actually self-insure that risk. But for everybody else, you're going to have to take a hard and fast look at how to maybe do it a little bit differently. Because I got news, guys. Adult onset dementia, cognitive declines, all these things are a risk. And we're not here to sell anybody insurance. We're here to help you find a solution. Have a dedicated, commitment, written financial plan as to how you're going to pay for long-term care expenses if you're self-insuring, or how you too can take an integrated approach by taking a sleeve of insurance, so long as it covers home health care, community care, assisted living, skilled nursing, so long as that the test is that it requires you to need help getting assistance with. I didn't say couldn't do. I said needing assistance with those activities of daily living. So long as making sure that the person who determines whether or not you need assistance is your physician, not an insurance company adjuster. Making sure that the benefits you receive are tax-free. Making sure you structure a policy solution where you never have to worry about a premium hike. And of course, ensuring that if you're going to invest in that policy, that even if you don't have a long-term care claim, that all the monies you put in, aka the premium, are still going to revert to your beneficiaries through your estate plan. That's the solution that people need. That's a part of the rebalancing process as well. That's a part of worrying less and living more. And I want you to connect with us and connect with our long-term care specialist, Jean, so that you too can start making sure that you have the critical protection that you and your loved one needs should there ever be a long-term care issue, especially if you want to bring care in the home. It's competitive for resources, it's expensive, and we too want to make sure you have the right financial resume. 833-964-PLAN. That's 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Download for free our guide, Short Introduction to Long-Term Care, and connect with us so we can help get you educated to get you empowered to make the best informed decisions. You've been listening to Craig and David Bolanos. This is In the Know with VestGen Wealth Partners on AM 560, The Answer.